In this webinar, we are going to talk about the IT landscape in the current scenario, navigating the disruption faced by the IT companies and what kind of opportunities could throw and benefit these IT companies. So before moving on to that, we will see some interesting facts on what is the contribution of IT sectors to the Indian economy. If you look at in the total GDP, it contributes 7.3 percentage, and overall the tech industry's revenue is around $283 billion. And the share of India's service exports is 43 to 45% is contributed by Indian IT companies. And from an employment perspective, 58 lakh of talent is working in this tech industry. And 36 percentage of women employees are working also in the tech industry. And there are more than 1,750 global capability centers in India. In terms of patents filed, in calendar year 2024, 90,000 patents were filed, especially in the tech industry. Not only it does contribute to the overall economy, it also contributes to the employment job creation for the whole economy. You can see in this chart, in 2003, the headcount was 1,100,000 in 2003. In FY23, it have reached more than 15 lakhs. So the IT industry headcount, it's a steady driver for the future predictability of IT industry's revenue growth. And so far, the industry have been providing the headcount growth consistently for more than 25 years. And if you see in FY24 and FY25, this number was stagnated and it was started to degrow. In FY25, the IT headcount in the top 5 IT companies is around 14 lakhs due to the IT companies hiring slowdown because of their macroeconomic slowdown and the uncertainty which is happening in US and Europe. So historically, headcount growth was a key driver for future revenue growth. But we will talk about more on how the divergence of headcount growth and the revenue growth starting to take place in IT companies. It also helps the Forex stability for the economy. If you look at the aggregate revenue for top 5 IT companies as a percentage of India's Forex reserves, in 2003, it was around 4%. And in FY25, it reached all the way up to 12%. India's service exports, mainly from top companies like TCS, Infosys, HCL, Wipro, they all bring in foreign currency earnings since global clients pay in dollar, euro, and Great British pound. These inflows directly add to India's current account receipts, which contributes to RBI's buildup of forex reserves. During 2004, India had around $100 billion worth of total reserves, and post that it has been continuously increasing in the forex reserve, and top 5 IT revenues increased its weightage and share in the India's total forex reserves. If you look at the tech industry's weightage in the market capitalization of the index, it has been steadily growing. For example, in India, if you take Nifty 50, in 1995 or 96, tech industry's contribution to the index was just 0%. And slowly in 2005, it came all the way to 5%. And in 2025, we are seeing a 17% weightage in Nifty 50. And for other countries as well, there has been a steady increase in tech industries contribution like S&P 500, MSC ACWI index, emerging market index, Japan Nikkei index, Germany DAX index, and UK's FTSE index. This reflects the capability and the positioning of tech industry in the overall economy as well as in the market capitalization of their indexes. So historically, IT services growth was growing at a premium of 2 to 2.5% to US real GDP growth. So if you look at these numbers, this index is JP Morgan IT Service Index, where they track the IT services revenue for the period of last 20 years, and they have compared it to US real GDP growth. And in the median, if you look at it was 2%. So let's say if US real GDP grows by 3 to 4%, IT services index would grow at 5 to 7%, reflecting an above premium growth to US real GDP growth. And it also emphasized the increasing spending of tech in the across industries, by various companies. According to Gartner, where does all the IT services spend is going through? We can break down into two parts. One is infrastructure management, that is building the hardware, building the necessary storage systems, servers, networks, and all the computers and laptops used by the system, and the entire infrastructure operations which can take care of the IT services and the clients' day-to-day process and work. And if you look at the other portion where we can see the application management software, so it caters to the CRM, ERP, HR, and supply chain, core banking. These kind of softwares were driving this overall IT services spend. And IT services is a subsegment of a $1.3 trillion overall IT spend. And IT services are everything required to help the customers design, build, and run their IT stacks. As ITs become more important to the companies, it has become increasingly difficult for managing them in their in-house due to its increased complexity. And if you look at the next slide, that is the reason why within IT services spend, there has been an increased contribution of IT services in the overall total IT spend. And if you look at this graph, in 2011, in the overall IT spend, 25% was only contributed or only catered to IT services. And in 2023, it have come all the way to 30%, which means within those IT services spend, IT hardware is a matured market. Even though IT service is also a matured market, it tends to take a lot of share from IT hardware due to the increasing need of software systems, IT systems, and all the way up to new technologies like AI and Gen AI. If you break down further IT services spend, as per Gartner, 25% will go to system integration, where companies like TCS, Infosys, HCL, Wipro all come into play for managing the company's day-to-day operations like HR systems, payroll systems, ERP, and server maintenance and all. And 20% goes to BPO and hardware, and 20% of share will be taken to consulting, where companies like Accenture, Deloitte, EY, KPMG, they all come into play in order to start and design the IT systems. To prepare those IT systems, what kind of architecture and technology we can provide to the companies. And then it goes to managed services companies, which thereby includes as well Cognizant, TCS, Wipro, HCL, where they will manage the day-to-day operations. So broadly, you can look at it as Accenture or strategic consulting companies will prepare the plan and outlay on where to spend the tech budget for a company. In the second layer, companies like TCS, Wipro, and HCL will come into play where they will exactly build those systems, they will run those systems, they will manage the entire day-to-day operations of the end user and the client to maintain their work stably. So before proceeding further to see the technological transformation across cycles, it is very important to note that why India emerged as a major IT hub. So it was during 2000s where large and skilled English-speaking talent pool was available in India, and there was a significant cost advantage compared to countries like US and Europe. There was government policy support as well. Post liberalization, they reformed their money policies so such that the private sector investments from foreign would allow to flourish the economy. And there was also a global delivery model, and India positioned themselves as a unique selling point compared to other countries due to the above reasons. So now we will look into the journey of IT services. In the early 90s to 2000s, the Indian IT services was laying its foundation and building global credibility. The core services were application development maintenance, which involved creating and managing the custom software for global clients. And there was Y2K redemption project as well, where Indian IT firms gained worldwide recognition by fixing the legacy systems, which was built in COBOL and Fortran, and that were risk at the crashing due to the year 2000. there was an issue of 2008 issue where these languages could not able to recognize, and there was a need for large amount of people to solve this issue, and India captured that part of the growth. In terms of ERP adaptation, it was a very early stage, and proper ERP adoption was not there, and companies were more focusing on installing softwares and through licenses, and the cloud part which came later in the 2008. So the main technologies which are used are mainframe platforms such as IBM systems and programming languages like COBOL and Fortran. So they were all dominant in critical applications like banking, insurance, and manufacturing. By the late 1990, the industry also began transitioning from mainframes to client service architecture. So it was a stage where these companies were slowly shifting to modern stage IT systems. During 2000 and 2008, the Indian IT service industry entered its first major growth phase, riding on the back of globalization and the rising need for enterprise technology. The core services which were provided in that period was ERP implementation, where companies like SAP, Oracle, PeopleSoft began to grow rapidly due to the wide-scale adoption. And that was the same time when BPO and KPO were expanding rapidly due to the competitive reasons which India had compared to other countries. So this is also an era of this rise of IT consulting and offshore infrastructure management, and the technologies used were client servers arc system, the relational database like Oracle SQL Server came into picture, and there was also a time when because these ERP implementations were started, the programming language and technology which related to that, including middleware, Java, .NET frameworks, began to rise rapidly during that period. So post dot-com bubble, dot-com crashed, wiped out many US clients, and the demand was collapsed, and Indian IT stocks fell 60 to 80%. This was a time when everybody thought that tech industry would gone because all the hype which are created in the dot-com bubble have been completely eroded, and everybody thought that tech industry would collapse and vanish. But firms survived due to large client base as well as increasing technology spends and cost advantage. So corporate cut cost, which increased its propensity to outsource to India compared to other countries because of large speaking English population, cost advantage to other countries. So Indian IT shifted from dot-com projects like ERP, maintenance and system integration during this period. And as I've said, outsourcing began to become more popular and many companies started to include in their portfolio of services. So in 2003 to 2007, it was a golden period where, to say few examples, Infosys grow at 30% and TCS listed at that time and they are also growing at a rapid pace. And Wipro, they expanded globally and BFSI sector emerged as the biggest vertical, cementing India's role as the global outsourcing hub. So during 2009 and 2015, the adoption of cloud was started increasing. The Indian IT industry experienced a major shift as the world adopted the digital transformation and the cloud era began to take shape. The core services during that period was cloud adoption and migration services, like from on-premise to their cloud service provider. Mobile app development, data analytics, and big data usage was also increasing during that period of time. On the technology side, this period was defined by the rise of virtualization tools like VMware and which enabled the more efficient use of server resources and laid the foundation for scalable cloud computing. Enterprises began experimenting with public cloud providers like AWS and Azure, setting the stage for large scale cloud adoption in the following decade. So this phase marked the industry shift from being primarily an outsourcing destination to becoming a partner in digital enablement, preparing the Indian IT firms for the cloud first, mobile first that would dominate the next decades. So during this period, what services should be outsourced to the Indian IT vendors was mostly decided by chief chief information officer and chief executive officer. So most of the tech budgets during this year was controlled by these CIOs and CEOs, and they began to increase the offshoring rapidly to countries like India and other countries. So post global financial services, Indian IT revenue versus Gartner IT spends reflect that Indian IT revenues were growing more faster than Gartner IT spends, which reflects that Indian IT companies were gaining global market share. Not only the not only due to offshoring, but also they were also gaining from companies like Accenture or Cognizant during that period due to the cost advantage, and the majority of the decision making was decided by CEOs, which prompted them to more increase their services to offshore units, which it could able to cut their cost. So just to have a few examples, if you look at HCL Tech's revenue in 2002, it was around 1,600 crores, and they began to scale rapidly after slowly to 6,600 crores during that period, and that operating profitability was also increased during that period. And if you look at TCS, they're also growing at a good pace from 9,000 crores to 20,000 crores, impacting the scalability, and they were able to gain more market share from other companies, other global companies. And if you look at the transition from on-premise to SaaS, in on-premise, the data application, database, and operating systems, virtualization, the server and storage, and network and data center, all these things were managed by the client. So they find it difficult to manage it, and they could not able to scale beyond a particular time. And they were also need flexibility in terms of using the storage, and they don't need to pay the full storage system, even though they are using partially. And that's how the emergence of SaaS came, and uh, most of the services most of the services within the SaaS accept the data as it is very critical and it will still stay with the client. Other services which were captured by the SaaS companies, which are slowly offshore to outsourced to Indian IT vendors, and cloud became a major growth driver during that period. This is Accenture's cloud revenue. The reason I have put this is that in 2010, the trend of cloud adoption was increasing, and during the time, everybody thought that Indian IT services providers work could decrease as many of the work is moving from on-premise to cloud, and these services which can't be anymore worked by the Indian IT companies. They thought that they questioned the existence of Indian IT vendors. But while cloud impacted the growth in managed services for infrastructure, the total IT spending continued to grow because of the following reasons. First is, even if a client starts to adopt the cloud, it is very difficult for them to increase the scale and handle its complexity. So still you need the help of IT vendors whom they can manage the IT solutions and the SaaS solutions and services. And hyperscalers like AWS and Azure, they don't have the service capability because they are more focused on the product. And there was always a need for service companies like TCS, HCL. They were able to gain those market share due to the service which they have provided. And once enterprises migrate to cloud, they have new problems like how to leverage the cloud to save the cost, build the custom applications. So Accenture estimated only 18% of end clients fully leverage the cloud capabilities. So there was always an incremental demand, even though the shift which from the on-premise servers to cloud revenue have transitioned. And this image exactly showcases the revenue potential and which Accenture captured post the adoption of cloud. So during 2015 and 20, digital transformation initiatives were popular and where clients are across industries were reinventing themselves with the new age technologies. The emergence of IoT, robotic process automation became mainstream, enabling companies to automate repetitive process and connect all those devices for real-time monitoring. Additionally, the gain of cyber security and AI-driven IT operations gained prominence. Even though we post 2022, the release of ChatGPT, everybody came to know the existence of AI. The AI era, which was started around 2016 in its very early stage, and the adoption we are feeling currently in this IT industry. If you look at the industry's financial, it was the sales was growing at a 35% CAGR post the global financial crisis, and their profitability as well as operating metrics were also super because they were not facing any threat due to offshore. And majority of the IT services vendors, especially Indian IT service vendors, their workforce was majority in offshore, and the shift from offshore to on-site was more prominent in Trump's first era, and we will talk about in the later slides. So if you look at the Indian IT revenue, which is Gartner's IT spends during the year 2016 and 2020, the growth was slowed compared to the previous period as the mobility and cloud created the fragmentation of buyer, and more companies were started to emerging and gain the market share of top IT companies. And in this period, most of the decisions was taken by the business head as they need to solve the business problem. Earlier, CEO and CTO had the power to increase or decrease the IT budgets and choose the IT vendors. But in this era, we have seen a complete shift where CXOs and business heads have the capability and power to determine the IT budgets as well to determine which IT service vendor you need to partner with. In Trump 1.0 era, this chart clearly reflects in different administrations how the IT services have grown in the dollar terms and how the BFSI revenue have grown and the profitability have grown. So if you look at during Obama's period in FY 13 to 17, in dollar terms, the revenue grew by 9%, and BFSI being the biggest contributor of Indian IT services, not only Indian global IT services, it contributed 8% CAGR during that period. And average margins were 24% as more companies were comfortable in deploying the workforce in India rather to shift them to on-site, thereby increase their cost. And during Trump era in FY 70 to 21, the dollar terms revenue slowly decreased to 6.3%, and the margins were hit very badly due to the reason that Trump became the first candidate in this era, and he was slowly pressurized the IT vendors to increase the onshore capabilities or nearshore capabilities so that their contracts will still remain safe. And many companies were not prepared to this were not prepared during this time. They slowly started to migrate those workforce into on-site or nearshore delivery centers, thereby increase the cost significantly. And the growth was also moderated. That is reflected in the margins. And post that, in the Biden era, of course, the COVID became a huge driver, which again drove the IT services spend, which grew its revenue by 8%, and the average margins were still at 21% because of increased competition, not only from global players as well as tier 2 Indian companies like Persistent or Coforce. They were easily able to capture those uh, market share from the top Indian IT companies due to the cost advantage, as well as the reason, as well as the fact that clients, the decision making was more given to the business heads, and these business heads choose to uh, partner with an IT service vendor who are more specialized into, and they don't need a full-fledged capability, and they would simply go to an IT service partner who are more niche and specific to only BFSI or only healthcare or only retail and manufacturing. And if you look at the EBIT margins, the company, all the top five IT companies, uh, it suffered a lot in EBIT margins because due to this increase in cost, and there was also a diminishing growth. And if you look at the net profit, net operating profit after tax, the rolling CAGR was at when you look at the end of 2019, TCS grew its NOPAT by 9%, Infosys grew its NOPAT at 5% because Infosys were the most hit company, and Wipro was also them in in their adoption of changing its offshore capabilities to on-site capabilities. So from 2020 to 2025, IT services industry has defined by the post-COVID digital acceleration and the rise of Gen AI. So the core services during this phase include AI-first consulting, where companies advise the clients on adopting and implementing Gen AI operations and intelligent automations to enhance their productivity. And there was a huge shift. There was a huge push in adoption of cloud because everyone were not able to move out of their homes, and the digital adoption was started to gain traction. And many of the client who was in the regulated industry, it prompted them to move to a, SaaS-based provider compared to an on-premise compared to on on-premise storage services. And they prompted companies to hire more during this period. And the wage hike was also high during the post-COVID era in 2021 and 2022. And the technologies like learning model, large language models like GPT, Azure, and OpenAI have also began in traction. And edge computing, low code and no code was gaining traction. And there were more companies looking at the industry specific cloud solutions and rather going to a vendor who has all capabilities. So as I've said, the remote workforce shift have moved 90% of the workforce to work from home. This also improved their margins significantly, and was there was a digital acceleration which surged the demand in for cloud, cybersecurity, e-commerce, and collaboration tools, which recorded a historical high deal wins. And there was a talent war because during the period of 2021 and 2022, IT companies faced a severe attrition because of the need for IT employees in various companies, and IT vendors were also able to provide a good package for them because of the growth which they had. So post 2022, post the Russia-Ukraine war and the rising interest rates, clients slowed down their discretionary spend, and new opportunities like Gen AI, cloud native, and cyber security postponement in wage hike was also happening during this period. So if you look at from 2020 to 2025, the growth was pretty flat. And from 2023 to 25, the growth flat was more visible. And their operating profit margin was also decreasing as the competition have increased. And also the growth was not coming because of of the reasons which were discussed earlier. And they were able to bear the high fixed cost. And due to the emergence of AI and majority of some of the market share which was gained by those companies like tier 2 Indian IT companies, they were able to deliver at low cost comparatively to other companies, and which posed a significant cost pressure on them. And this is an era where dividend payout for Indian IT companies went up hugely because they don't no longer want to invest in any they no longer want to invest in any service capability. They will simply acquire, and they know they don't need such much of free cash flow. So they started to pay. The dividend payout was very high during this period compared to other periods. So if you look at the IT sector's revenue growth, it was mostly in line with S&P 500 revenue growth. And if you look at the start, during 2012 and 2019, there was a premium in which S&P 500 grown at 4 to 5 percentage, and Indian IT companies grown at 12 to 13 percentage during that period. And post that, it has been normalized, and it is expected to grow in line with S&P 500. And if you look at within S&P 500, the top seven magnificent companies are performing really well. But the other S&P 493, which we exclude the top seven companies, they are not doing comparatively better than S&P top seven magnificent companies, which leads to an increased concentration within S&P 500. And that's why you can see in Indian IT's Q1 results, majority of the companies have posted good growth in the tech and IT related verticals, whereas in others verticals like retail and manufacturing, they are able to hit by the tariff uncertainties and the sluggish consumer consumption in US. So this chart will clearly reflect the region-wise growth in the last decade. So if you see, majority of the IT companies still get a larger portion of revenue from US, which is close to 55 to 60 percentage, and Europe will come at 25 to 30 percentage, and rest of the world would have a very lesser share. So Post-COVID, after the bump which created a pent-up demand in FY 24 and 25, in the US growth was very flat. The Europe growth was also flat, but it was comparatively and relatively better than US. And the rest of the world growth was really good. And this bump in FY 24 is due to the large deal win which TCS got from BSNL, which increased the overall portion of their revenue in the share. And companies also started to think it's high time we need to diversify from US, because we need to diversify from US, we need to enter into new geographies or increase our presence in rising rest of the world markets like Middle East, India, or Japan, where there is an incremental potential and opportunity to gain that share because of the ongoing investments in those markets. And this is a broad trend of EBIT margins of top four IT companies. You can see a gradual reduction from 24.6% in June 2014 to 21% in 2025, which clearly reflects there is a pricing pressure. And being a mature industry, it is difficult for them to grow at such a large high growth without any trigger in growth. And they can't able to do the services which they are providing at the same cost, and which we will look into the later slides. What is the reason of pricing pressure which companies are facing? And in terms of cash flow conversion, if you look at last 3 years, TCS cash flow EBITDA to cash flow from operations growth, it was around 7%, and the conversion was around 75%. And prior 3 years for TCS it was around 84%, and for Infosys it is 83%, which clearly reflects there is an increase in credit period, or their payment collection is becoming more stringent because of the competition and because of the lesser deal wins which the industries are uh, having. And it would put pressure more to companies like TCS, Infosys, and we are seeing a high pressure to tier 2 companies like Persistent, Coforge, Mindtree, where their prior 3 year cash flow to EBITDA conversion was more than 70-80%, and now it has slowed down to 60 or 63%. As the as the environment remains difficult in a macroeconomic situation, winning deals is a struggle, as well as collecting payments from the vendors is also becoming a struggle, which clearly reflects from this data. And the free cash flow conversion from the profit after tax was also not good for TCS and Coforge and Persistent and Cognizant, because these companies do not have a payable or an inventory because it's a service provider. So these cash flow can be converted with an efficient collection period. And if you look at the seasonality of IT companies' returns, especially the Nifty IT, majority of the returns have more weight in the second half of the calendar year. This is due to the fact that typically in a financial year, starting from Q2 and Q3 up to Q4, Indian IT companies will have a large deal pipeline, and the conversion of deal to revenue will be more visible during this period. And it's clearly reflecting in the chart. Thereby, in last 20 years, we can see a good nifty IT returns in the second half of the calendar year. And so far, you might have noticed that IT sector is not doing well since the start of the year, and we can expect the reverse in the trend following this last 25 years trend, wherein the nifty IT returns can be comparatively better in the second half of the calendar year. If you look at the tier 1 and tier 2 growth, starting from FY 18 to 22, there was a significant divergence between tier 1 growth and tier 2 growth. And tier 2 IT companies consistently outperform tier 1 on dollar terms revenue growth. While this outperformance is likely to continue because these companies have a relatively better niche in what they are providing, and they can able to do at a lesser cost compared to tier 1 IT service providers. And clients are thinking, why not outsource to him so that I can take care of my cost? And if you look at this, in FY 25 as well, tier 1 revenue grew at 3%, whereas tier 2 IT companies dollar terms revenue growth grew at 10%, which is clearly indicate a significant divergence in tier 1 and tier 2 growth. If you look at the valuation of top 4 IT companies, so it's trading at a forward P of 24 times, which is 37% premium to pre-COVID 3-year average. And the reason is that even though Indian IT companies are not having a good environment or a good deal pipelines or discretionary consumption, the relative value investing plays out here. Thereby, if mutual funds or FIIs need to invest in India, they can feel more comfortable investing in top Indian IT companies, which have a 90 to 95 percentage of dividend payout, and they can able to protect their downside risk, thereby investing in these companies. And this is one of the reasons why it still trades at 37 premium to pre-COVID 3-year average. So if you look at Nifty IT's premium compared to Nifty, in the last many years, it was hovering around 1.45 to Nifty, which means it was always trading at a premium of 45 percentage compared to Nifty uh, as an index as a whole. And if you can see in 2022, it created a large share in the outstanding Nifty index because of the reason which we discussed earlier. And it was trading at 2 times premium valuation compared to Nifty 80 companies. And slowly it started to decelerate and it have come all the way up to 1.4. And it is still trading at premium and it will trade at premium because of the reasons which we have discussed earlier. So if you look at the quarterly results of IT companies, TCS in dollar terms, they have degrown their revenue. Infosys become an outlier and HCL also is an outlier. They grow at comparatively better numbers compared to other companies. And Infosys growth is more focused on Europe and especially retail and manufacturing. And whereas if you look at HCL, they have a diversified portfolio of industries as well as ER&D and software. And interesting fact to note in HCL Tech is their ER&D revenue, which grew at 12% this quarterly one, which constitutes to around 12 or 13% of their overall revenue. Despite the fact that many companies are shrinking their R&D spends, and these companies could able to grow at a decent pace even in this tough environment, which reflects in the valuation premium of HCL Tech compared to other companies. So historically, this is not always the case, whereby TCS have had a more premium compared to other companies. But now, if you look at HCL Tech valuation, it's relatively better than TCS and Infosys due to the fact that they are able to get those deal wins and they are able to post the revenue growth better. And in terms of EBIT margins, Wipro and HCL Tech did not perform well in this quarter, and other companies too did not perform well because of increased cost of employee and there was no growth. Growth was very less, so they had a high fixed cost in their expense, and they also need to invest in new technologies. And that's the reason why we are seeing a EBIT margin basis point 50 to 80 basis point decline in the whole IT companies. And if you look at the performance versus consensus graph, majority of the companies did not perform well in quarterly one, and consensus was expecting a higher growth in fourth quarter FY25 and upcoming quarters, but it didn't happen due to the tariff related uncertainties, high interest rates in US, and other reasons, and their profitability also impacted. And at least the near term, in the next 3 to 6 quarters, it's very difficult for companies to increase their EBITDA margin without having a good growth and having a good deal pipeline and converting into revenue. So if you look at the India's IT services revenue, in overall $254 billion, 75% is coming from the existing services and 25% is coming from GCC. And this GCC revenue is expected to grow at 7 to 8 percentage in the next 5 to 6 years. And the headcount mix is as well increasing because workforce are more prone to work in GCC because of a 30 to 40 percentage better pay compared to regular IT companies, which have a lesser pay for the Indian IT companies. So there are three different models in GCC. One is assisted GCC model, where the complete ownership and the control will be taken care of the parent, and only those non-core services will be outsourced to Indian IT service provider. And this support includes infrastructure setup, talent acquisition, administrative services, and MNCs would be able to have a strategic balance between a cost management and operational control. And the next way of operating this GCC is a very famous and which is gaining faster traction among India, which is a build, operate, and transfer model, wherein initial stage of building and operations will be taken care of the Indian IT companies, and in the later stage it should be transferred to the parent MNC or the GCC. And if this operation, the GCC is they could not able to scale those GCC, or they could not able to achieve the desired outcome, they would simply close this GCC. It was visible during the time in 2009 or 810, where Citibank had opened the GCC in partnership with TCS, and later they closed due to the fact that they could not able to scale and they could not achieve the desired outcomes which they need, and they later sold back to TCS. And there are many cases which related to that. And build operate BOT model is a risk-free model for a GCC because you don't need to invest in upfront, and the initial trigger and the services will all be provided by IT companies, and you just need to check whether you are achieving the desired outcome or not. And this joint venture model, IT services vendor would invest along with the GCC and co-manage the GCT unit, whereby it is partly in between the assisted GCC model and BOT model. And within these three models, the BOT model is gaining more traction due to the fact which we have discussed earlier. So if you look at this graph, during 2015 to 2020, 75% of GCC were in-house and only 25 to 35 was provided by a vendor, which was Indian IT companies. And it slowly started to migrate, wherein they could able to gain more market share from the in-house GCC. They could able to gain wallet share from the in-house GCC services. And if you look at the percentage share of different models, in 2015 to 20, more assisted models were used and joint venture model was used. And in the later part of the time, BOT models was used as companies felt it is a risk-free model and you could be able to scale that. And post scaling, they could able to transfer the ownership of the GCC to back to its parent MNC. This could hereby reduce its risk, and it's a way of trial and error model, I would say, because you are not initially investing in anything, and these IT vendors will take care of those services, and you could able to have a better view and predictability over the years. And this is how it's evolved from being a cost catalyst, from being only to reduce the cost, to now most of the high quality engineering works within IT services. It's being transferred to GCC due to the fact that they need to have a good control of or IP to their within their organization. And these Indian IT companies are also suffering a long-term threat from GCC, but it provides an intermediate opportunity wherein, let's say, HCL Tech would partner with some other GCC to provide those and operate those GCC, which could create a near-term revenue opportunity, but a long-term predictability is still very low in this GCC-based model. And this is a broad comparison of margin profile between GCC and Indian IT vendors. So if you look at this thing, captive units have similar margin profile compared to mid-size vendors, and large-size vendors are able to have a better margin profile due to the economies of scale. And major cost for a GCC unit is employee salary, which contributes around 70 to 80% of their cost, while the general administration markup cost the rest of the cost. And for Indian IT services, they need to invest in sales and marketing as well. For GCC, it's no other issue because you are getting the work from your parent and you don't need to market to anybody because you are eventually working to your own company. So even though there could be the slight difference in margins, GCCs are considered to be a growth driver for Indian IT companies. And these are few examples. Like HCL Tech partnered with ChargePoint, it's a US-based company which they have established an advanced R&D center in Bangalore. And for Infosys, Rolls-Royce, an aerospace company, they created a JV with Infosys for digital and engineering innovation center for their R&D. And to conclude, AI-led deflation is real, and companies are looking to mitigate this risk by providing value-added services to provide at a more lesser cost or to include their AI segment or portfolio within the service which they are providing, thereby protecting their growth in upcoming years. Though GCC will act as a revenue driver in the short to mid-term, long-term growth is still low because at least the top four and top five IT companies face some threat in the long term due to the fact that post the build, operate, and transfer model, the predictability of whether they will retain the revenue share is very low, thereby posing a long-term threat in the GCC model. And TCS have recently laid off 12,000 employees, and which is not normal. And TCS is generally a restrictive guy, and they have been postponing this issue internally, and they have finally come to a conclusion to lay off those people. It is not only due to the AI, where the other factor is that post-COVID they hired a lot of employees, but the revenue and growth didn't come. They were supposed to clear those bench workers in order to remain competitive in terms of cost. And we are already seeing a gradual shift in revenue and headcount, and it will further diverge due to the fact that you need a lesser employee base to provide a more value-added services. And it could create a industry-wide long-term trend uh, in the upcoming years. And many people are questioning the survival of IT companies. The survival is not a question. The question is whether they can be able to provide more services such that they can protect their growth is a question. So they will still survive, but there are a lot of efficiencies to be passed on. And what we are seeing now is that for every service which Indian IT companies are providing, they have a compulsory inclusion of AI element in those services, whereby they need to they need to provide and prove to the vendor such that we are including AI in some part of services. Thereby, we are reducing the cost. Thereby, we are reducing the employee base, and those benefits which should be passed on to the clients. And due to this uncertainty, the full benefits that they are realizing, it should be passed on to the end client in order to retain the deal.